What's the best way to invest $100 in 2025 if you had Warren Buffett investing principles and Donald Trump setting the rules? Because that's the big question right now. Inflation, AI, elections, gold spikes, and crypto roller coasters. It's a wild time for investors. But if you had to pick just one smart way to grow your money today, what would Buffett say? And how does a Trump presidency shape that decision? Well, to answer that, I am doing something different. I am forecasting forwards. I'm taking $100 and running it through 6 different types of investments, the exact same ones you've probably heard debated 100 times online: company stocks, REITs, crypto, gold and silver, and ETFs. But instead of asking what worked before, I'm asking what'll win 5 years from now. And just like in Buffett-style investing, I am not guessing blindly. I will be looking at actual data, real asset performance, historical averages, Trump's economic playbook, and Warren Buffett's current portfolio. But most importantly, we're going to be scoring each investment live in real time using a grid. Here's the framework I will use to compare each one. Mastery. How much knowledge do you really need to make this investment work? Automated income. How much money can you earn without lifting a finger? Tax optimization. Are there smart ways to keep more of your profits? Threats. What's the real risk of losing money here? And finally, gain. How much could your $100 grow over the next 5 years? We'll fill this grid out one row at a time, starting with company stocks, and build toward a full picture of what investing looks like in this Trump-Buffett economy. By the end, you'll have a crystal clear breakdown of where your $100 is best placed in 2025, and exactly how much it could be worth in 2030 in terms of dollars. And if you want to use a different amount, I will also show it in terms of percentage growth. Starting with our first asset, company stocks, Buffett's bread and butter. When you buy a stock, you're buying a small piece of a real business, like owning a slice of Apple, Coca-Cola, or Chevron. It's a way to share in the company's success, and over time, that can turn into real money. Now, how do you actually make money from stocks? 2 ways. First, appreciation. The stock price goes up, and you sell it for more than you paid. Second, dividends. Companies share a portion of their profits with you regularly, just for holding the stock. This is the arena Warren Buffett knows best. His whole strategy is about buying great businesses at fair prices and holding them for years. He looks for companies with strong earnings, durable competitive advantages, and solid leadership. That's the Buffett way. But under a second Trump term, we do see policies that favor certain industries: defense, fossil fuels, American manufacturing, and that changes the game a bit. It doesn't break the Buffett model. It just shifts where the opportunities are. So how does the Buffett strategy fit into this world? Let's break it down. First up, mastery. I'm putting this one down as high on the grid, and here's why. Buying stocks Buffett style isn't just, I like Tesla, let's go all in. No, you need to read annual reports, decode cash flows, look at price-to-earnings ratios, evaluate management, and understand a company's moat. That's Buffett speak for competitive advantage. It's work, but it pays off. Let me give you an example. When Buffett invested in Apple, he didn't just go by the brand or product. He looked at its massive cash reserves, its sticky ecosystem, its insane return on equity, and most importantly, its pricing power. So there is a learning curve to it. So I am marking it down as high, and deservedly so. Let's fill that into the grid. Mastery, high. Now let's move to automated income. Buffett is a big fan of dividend stocks. They pay you just for holding. And one great example here is Lockheed Martin. It's one of the biggest defense contractors in the world. With Trump promising increased military spending, this one could seriously benefit. Lockheed Martin pays a dividend yield of about 2.71%, and it's raised that dividend every year for over 2 decades. So, even if the stock price flatlines, you're getting checks every single quarter. Set it and forget it. Automated income, good. All right, let's talk about tax optimization. You want your gains to actually stay yours, right? Good tax planning is crucial. In the US, if you hold stocks in a Roth IRA, those gains and dividends are tax-free. Even in taxable accounts, long-term capital gains get a lower tax rate than your paycheck does. Lockheed Martin fits beautifully into this. If you hold for over a year, you're probably paying less tax than you would on a savings account. Tax optimization. Great. Now for the big one, threats. Let's not sugarcoat it. Stocks can blow up, even good companies. You might remember GE or more recently Zoom, flying high one year, diving the next. Even Buffett's biggest investments carry risk. You could get caught in political turmoil, market crashes, or just bad management. And with Trump likely to shake up regulations, tariffs, and foreign policy, certain industries could be winners, others losers. So even if you've done all your homework, things can still go sideways. Threats, high, lock it in. So, how much can you make? Let's plug in some numbers. You invest $100 today in Lockheed Martin. With an estimated compound annual growth rate of 5.44% plus dividend reinvestment around 2.71% annually, you're looking at a projected value of about $146.30 in 5 years. That's a gain of 46.3%. But let's not stop there. What if instead you picked Occidental Petroleum, another Buffett pick, and one that's set to benefit from Trump's pro-oil stance? That investment is forecasted to reach $262 in 5 years, a gain of 162%. And then there's the safety play, Apple. That's projected to grow your $100 into about $233.50, a 133% return. So for this category, we are looking at gains of 46.3% to 162%. Next up, making money in real estate. But don't worry, I'm not telling you to go buy a house or deal with leaky roofs. I'm talking about REITs, real estate investment trusts. These are how regular people like you and me can tap into the real estate market, collecting rent, getting paid dividends, without ever dealing with a single tenant. Think of REITs like this. You pool your money with other investors, and that cash goes into buildings, offices, apartments, malls, data centers that generate rent. That rent, it gets passed back to you in the form of dividends. You don't own a whole building, but you own a slice of it, and that slice pays you. REITs are one of those income-generating assets that even Buffett doesn't hate, especially when they're steady, profitable, and run by disciplined management. Now, under Trump 2.0, we could see favorable tax policies and regulatory rollbacks that benefit real estate developers and commercial landlords, which could boost the outlook for certain REIT sectors. So, how do REITs stack up in our Trump-era, Buffett-style investment guide? Let's start ticking the boxes on our grid, one cell at a time. First up, mastery. Here, it's a mix. You don't need to be a financial wizard to understand a REIT, but there's more to it than clicking buy. You've got to know what sectors they operate in. Are they focusing on retail malls, data centers, storage units, or healthcare facilities? And how are those sectors positioned under the next Trump administration? Here's where it gets interesting. Trump has promised to bring back manufacturing and reduce regulations on commercial development. That could fuel demand in industrial and logistics REITs. A REIT like Prologis, which owns warehouses used by e-commerce giants, could benefit from this kind of policy tailwind. You'll also want to look at financial metrics like funds from operations, FFO, occupancy rates, and debt levels. FFO is a better measure than profit in this case because it strips out non-cash expenses and gives you a clearer picture of how much cash is flowing through the door. So, while REITs are simpler than buying an actual building, there's still a fair amount to learn. So let's say the mastery level required is moderate. Now, onto automated income. This is where REITs shine. Legally, most REITs are required to return at least 90% of their taxable income to shareholders in the form of dividends. That's not optional. That's baked into the business model. Let's take CubeSmart. Ticker symbol CUBE. They're one of the top players in self-storage, and they've been steadily expanding their footprint across the US. What makes Cube interesting isn't just that they pay a solid dividend, around 4.8%, but that their business thrives when people are downsizing, relocating, or starting over. And in an economy where uncertainty runs high, those trends often accelerate. Now think about this under a Trump second term. More population shifts, looser zoning rules, and a push for entrepreneurship could mean more demand for flexible storage, especially from small business owners and people moving for new job opportunities. CubeSmart fits right into that ecosystem. So when we talk about automated income, this is it. CubeSmart collects rent from thousands of tiny garages across the country, and every quarter, that cash flow trickles back to you as a shareholder. That is the true definition of income on autopilot. So, for automated income, I will mark REITs high. Let's move to tax optimization. This is the part that trips people up. Those big dividends REITs pay out, they're taxed at your regular income rate, not the lower long-term capital gains rate like with regular stocks. That means unless you're holding REITs inside a Roth IRA or similar tax-sheltered account, Uncle Sam's getting a bigger cut. The solution? Be strategic. If you're in the US, pop your REITs into a Roth IRA, and those dividends become tax-free. In the UK, use a stocks and shares ICA, If you don't plan, the tax bite is real. So we're going with moderate here. Great if you're smart about where you hold it. Now, threats. Real estate sounds safe, right? But here's the deal. REITs can absolutely tank. If interest rates rise suddenly, borrowing becomes more expensive, and REITs struggle. If people stop going to malls, retail REITs suffer. If offices stay half empty because of remote work, yep, commercial REITs hurt too. But not all REITs are created equal. That's why diversification matters. A data center REIT like DLR, far less likely to feel a downturn than a shopping mall REIT. And if Trump's economic agenda keeps interest rates in check to fuel expansion, the threat might actually shrink. Still, REITs are sensitive to macro shifts, so let's call threats medium. Okay, time for the fun part, the gain. Let's talk real numbers. You invest $100 today in CubeSmart. Historically, it delivered annualized returns of around 8.97%. And then if you reinvest the dividends, that would put you at about 185.2 after 5 years, an 85.2% return over the next 5 years. Of course, nothing's guaranteed, but this isn't speculation. You're talking about steady rent checks, real assets, and a dividend yield north of 4%. So let's update our grid. We have Mastery, moderate, automated income, high, tax optimization, moderate, threats, medium, and chaos gain, about 85.2% over 5 years based on historical returns. All right, now let's dive into the most controversial part of our investing grid, cryptocurrency. This is where opinions split fast. Some people see it as the future of money. Others think it's digital snake oil. It's fast-moving, unpredictable, and way outside the comfort zone of someone like Warren Buffett, who's famously called it rat poison squared. But like it or not, crypto is here, and it's reshaping parts of the financial world. So how does crypto even work? At its core, it's digital money that isn't controlled by any government. You can buy coins like Bitcoin or Ethereum, store them in a digital wallet, and trade them anytime, day or night. You make money when the price goes up, and lose money just as fast when it drops. But here's the twist. Under Trump, crypto might see a policy shift. He's been warming up to Bitcoin, hinting at looser regulations and even calling out central bank digital currencies as dangerous. If he pushes for more freedom in the crypto space, that could attract more capital and maybe even some mainstream acceptance. So how does all that land in our Buffett meets Trump 5-year forecast? Let's mark it down on our grid, one square at a time. For mastery, I'm calling this moderate. Crypto sounds like magic internet money, but once you break it down, it's not as scary as it looks. To get started, you'll need a platform. Coinbase is a common choice. Then, you pick your crypto. Most people stick to the big names, Bitcoin and Ethereum. There's no balance sheet or quarterly report to study like in stocks, but there are still fundamentals. Tokenomics, supply caps, utility, network activity. Bitcoin is capped at 21 million coins. Ethereum runs the world of smart contracts and DeFi apps. You don't need to master the entire blockchain, just understand what you're buying and how it behaves. That's why I'm placing this in the moderate mastery range. Not simple, but not rocket science either. Now, automated income. Most cryptocurrencies don't pay dividends, but staking is the crypto world's version of interest. You lock up coins to help the network process transactions, and in return, you earn rewards. With Ethereum, you might earn 3% to 5% per year. Some altcoins go higher, but also carry bigger risks. There's also yield farming and liquidity pools, but those are riskier plays. The takeaway is, yes, crypto can earn you income passively, but it comes with high complexity and exposure to platform failures. So for our grid, we're labeling this moderate for automated income. On to tax optimization. This one's a rough ride. Every crypto transaction is a taxable event in most countries. Buy Bitcoin, sell Ethereum, taxable. Stake coins and earn rewards, that's income. On top of that, crypto can't be held in tax-advantaged accounts like Roth IRAs or ISAs. That means every gain is taxable and needs to be tracked manually or through specialized tools. Until regulators catch up and simplify the rules, crypto earns a solid pour on our tax optimization scale. When it comes to threats, we're talking high, maybe the highest on this list. The crypto market can swing wildly. Bitcoin alone has dropped 80% multiple times over the past decade. Ethereum has followed suit. These aren't anomalies, they're features of the space. On top of price volatility, you've got regulatory risk, hacking risk, scam risk, and the emotional toll of watching your portfolio nosedive in a matter of days. Trump's return might bring looser regulations, potentially accelerating crypto adoption. He's already hinted at embracing blockchain solutions and even creating a pro-crypto US policy stance. But deregulation can go both ways. It might invite innovation or trigger chaos. Meanwhile, Buffett has famously dismissed crypto as rat poison squared. He wouldn't touch it. His stance? It has no intrinsic value, doesn't produce anything, and relies purely on sentiment. So we're going to mark it very high for the threats box. But despite all that, let's talk gain. Let's look at some numbers. Bitcoin currently sits around 105,000. Over the last 5 years, it has managed an average annual growth of 62.19%. This includes UPS and Downs too. If it manages to keep the same growth over the next 5 years, that turns $100 into roughly $1,122, a 10.22% increase. Ethereum also managed to keep the pace, averaging growth around 61.555%. So, with Ethereum, you would be looking at around $100, a 1,000% gain. But, and this is important, there's a real chance your investment drops 50% within months if the market turns. Anyone who bought Bitcoin in 2021 at the top knows what that feels like. High potential reward, but high emotional cost. To put that into perspective, let's lock in those values. We'll average that out and conservatively write 1,000% into our gain column. Up next, let's talk about the oldest form of money, gold, and its rising underdog, silver. This is real, tangible value. You can hold it, you can stash it. It doesn't vanish when a website goes down or a bank freezes accounts. Some people call it old school, but gold and silver have outlasted every currency, every government, and every financial crisis for thousands of years. There's a reason central banks still hoard it. Now here's what makes it especially interesting today. Inflation is eating away at fiat money. Global uncertainty is rising, and the demand for silver, especially, is exploding thanks to tech, EVs, solar, and military applications. So this isn't just a safe haven story anymore, it's about opportunity too. And under a second Trump term, with potential deregulation, pro-energy policies, and defense spending increases, both gold and silver could benefit indirectly. So, how do these two metals stack up in our 5-year investing grid? Let's work through it. Let's start with mastery. This is as straightforward as it gets. You're not analyzing a CEO's track record or calculating free cash flow. Gold and silver don't change. They don't report earnings. They don't surprise you with bad quarters. Buying physical metal? That's as easy as walking into a coin shop or ordering from a trusted online dealer. Want the stock market version? Just grab SLV or IAU. These are ETFs that track the price of silver and gold, respectively. Or take it a step further and invest in silver-focused mining companies like First Majestic Silver, AG, one of the most discussed silver equities with strong industrial ties. With all this simplicity, we're locking this in the grid as low for mastery. Next is automated income, and this one is brutally honest. It's a zero. Gold and silver don't pay you. No dividends, no staking, nothing. They just sit there. They're a store of value, not an income-producing asset. So if your goal is to build a passive income machine, these aren't the tools. Into the grid it goes. Automated income, zero. Next, tax optimization. This depends on where you live and how you buy. Physical silver in the US? Taxed as a collectible, 28% capital gains. Ouch. But hold SLV or GLD inside a Roth IRA or traditional brokerage, you could reduce or defer taxes significantly. In the UK, some gold coins like the Britannia are tax-free because they're legal tender, so we'll give this a moderate rating for tax optimization, because while not excellent, there are some clever legal routes to shield gains. Threats? Medium. Gold and silver aren't volatile like crypto, but they're not immune to price swings either. The biggest risk here is opportunity cost. While gold holds value, it doesn't grow fast. From 2013 to 2018, gold barely moved, but from 2018 to 2025, it climbed over 60%. Silver's even more dramatic, used in EVs, solar, AI, and more. As demand grows and supply remains constrained, prices can spike. But they can also stagnate if inflation cools or interest rates stay high. So it's not about losing your money, but losing growth opportunities. That's why we're marking threats as medium. Now, the fun part, gain. We ran the numbers. Gold is at $3,032 per ounce. Silver? About $36. Let's look 5 years ahead. Based on the supply shortages, growing industrial use, especially in solid-state EV batteries and solar panels, and monetary pressure, silver has serious upside. For our calculation, we are going to use iShares Silver Trust, SLV, and iShares Gold Trust, IAU. SLV has seen an average yearly gain of 15.23% over the past 5 years. This trend suggests that a $100 would be valued at around $203 in 5 years, a 103% gain. Gold, slightly less. Gain of 14.46%. That puts $100 at $196, a 96% gain. So with tangible assets, we are looking at around 96% to 103% gains. Before we move on, a quick word on Trump. Under a Trump presidency, we could see increased debt spending, weaker dollar policy, or inflationary fiscal moves. All of these tend to favor gold and silver. Remember, Trump himself has praised gold as real money in past interviews. That political layer might just add fuel to the metal fire. And finally, we arrive at what Warren Buffett calls the best choice for most investors: ETFs and index funds. If you want to bet on the entire market, not just one company, this is your lane. Instead of guessing which stock will win, you're buying a basket that tracks the whole market, like the S&P 500, or a specific sector like tech or healthcare. It's simple, diversified, and low cost. And that's exactly why Buffett loves it. Now, under Trump 2.0, if we see economic growth, deregulation, and corporate tax cuts, index funds tied to American business could get a real tailwind. Add that to the Buffett approach, buying and holding broad market ETFs, and you've got a setup that's boring in the best way possible. Let's take it to our grid one last time and map out how ETFs and index funds score, from mastery to gain. Starting with mastery. This is probably the lowest on the list. You don't need to research balance sheets or understand PE ratios. You're not picking winners, you're just buying the whole game. It's like betting that the economy over time will grow, and historically it does. If you're using an app like Vanguard or Fidelity, you can buy shares of ETFs like VOO, which tracks the S&P 500, or SCHD, which focuses on companies with strong dividend histories. You're instantly diversified. No need to analyze earnings calls or read 10Ks, so it is easy to understand. I'm going to put it in the low mastery requirement. For automated income, ETFs bring a solid moderate score, while VOO or SPY, which track the S&P 500, yield only around 1.5%. Funds like SCHD or VYM focus on dividend-paying companies and can yield between 2.5% and 4% annually. That means even a modest investment can start generating real passive income over time. For example, SCHD paid out roughly $2.50 per share in dividends last year. If you hold a sizable amount over a few years, that adds up, especially if those dividends are reinvested. So whether you're looking for slow and steady growth or reliable payouts, you've got options. So I will mark it moderate. On tax optimization, ETFs shine. Because they're passively managed, they incur fewer taxable events compared to mutual funds. Less trading means fewer capital gains to declare. And if you hold them inside a tax-advantaged account, like a Roth IRA in the US or a stocks and shares ISA in the UK, those gains and dividends can grow completely tax-free. Warren Buffett himself has said that most people should just put their money in a low-cost index fund and forget it. He's referring to funds like VOO, and precisely because they're tax-efficient wealth-building machines. So for this box, it is great. Now, threats. One of the strongest benefits of ETFs is diversification. You're not putting all your eggs in one basket. If Apple or Amazon slips, maybe Microsoft, Johnson & Johnson, or Pepsi picks up the slack. VOO, for example, holds over 500 large US companies. That kind of coverage significantly lowers your overall risk. Of course, systemic events like recessions or market crashes will hit everything, but over time, the market has always recovered. Historically, the S&P 500 has returned about 10% annually over the past 90 years. Let's lock that into our grid. For threats, low. This is one of the safest long-term plays available. All right, time to talk numbers. What does a $100 investment in ETFs or index funds look like in 5 years? Let's start with the classic. VOO, the Vanguard S&P 500 ETF. Historically, it delivered an impressive 14.23% annual return. With that growth rate, your $100 would grow to about $194.50 in capital appreciation. Add in around $9.63 in dividend income, and your total comes to $204.10. That's a 104.1% gain, basically doubling your money in 5 years the Buffett way. Next, if you're after higher dividends, there's SCHD, Vanguard's high dividend ETF. It's grown at 7.53% annually and pays a chunky 3.886% dividend. That takes your $100 to $143.80 in growth, plus about $24.12 in dividends. Combined, you're looking at around $167.90, a 67.88% gain. And for those who want to lean into tech, you've got QQQ, the Invesco Nasdaq 100 ETF. It's been on fire with a 17.16% CAGR Over 5 years, that could push your $100 up to $220, $70 in growth, and about $470 in dividends, bringing your total to around $225 or $40. A 125.4% return. Let's mark our gain box on the grid, 67.9% to 125.4% for the ETF index fund category. All right, so here we are at the end of our $100 investment journey, and the full grid is finally complete. Let's take a step back and look at what we've built together. Starting with company stocks, this path offered huge upside. Our projected gain of 46.3% to 162% over 5 years is a reminder that picking the right stocks can pay off big. But it came with serious threats. One wrong pick, and your investment can nosedive. Mastery here was high for a reason. You've got to do your homework. I'm talking cash flow analysis, PE ratios, and competitive moats. REITs came in as the surprising underdog. With their attractive dividends, decent tax optimization, and medium risk profile, they gave us a balanced option that's often overlooked. Our $100 turning into $185.2 shows why these are a smart choice for investors who want steady income without getting their hands dirty in real estate. Crypto was the roller coaster. Sure, we projected a 1,000% gain, and yes, there's big potential there. But we also saw how volatile and unpredictable this space is. And even though Buffett avoids it completely, adding a little to your portfolio could make sense if you're willing to stomach the swings and do your own research. Then came gold and silver. This combo was less flashy, but a heavy hitter in terms of historical reliability and protection. The projected 96% to 103% gain isn't just solid. It's backed by real-world trends like EV expansion, military tech, and solar growth. It's more than just a store of value. It's a strategic play for the years ahead. And finally, ETFs and index funds, the cornerstone of Buffett's strategy. A 67.9% to 125.4% projected gain may sound modest, but remember, it's low risk, high diversification, and basically zero stress. If you're looking to build wealth over the long run, this is the easiest, most reliable way to do it. Buffett says it, and so do the numbers. Now let's pause and think. What's the lesson here? First, it's not about picking the best investment. It's about finding the right fit for you. Your goals, your risk tolerance, your timeline. Whether you're building automated income, optimizing taxes, or hedging against economic threats, there's a strategy for you. Second, don't wait. That $100 today has the power to grow into something meaningful. The sooner you start, the more time you give compounding to do its magic. Even if you don't have it all figured out, start with something, learn as you go. And third, diversify. Even Buffett, who's known for concentrated bets, believes most people should spread out their investments. That's how you protect against uncertainty and position yourself for steady gains. So, whether you're going the Buffett route with company stocks, riding the volatility of crypto, or building a boring but beautiful ETF portfolio, remember, the best investment isn't just what you choose. It's the decision to get started in the first place. Want to know what super investors like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Mohnish Pabrai are buying in this uncertain environment? Click the video on screen to find out.